Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and thank you for joining us. My name is Mark Gregory, a Senior Manager in James Cooper Creston's Business Tax Unit, and I'm joined by Phil Snell.
Hi, so I'm a Corporate Tax Director based in our Reading office, specialising mainly in international tax for owner-managed and private equity-backed businesses.
We live in an increasingly global economy, and many smaller businesses need to consider international markets earlier in their development than might have historically been the case. Exploring markets outside of the UK for the first time can be a daunting prospect. The commercial, regulatory and legal environment will probably be unfamiliar. Unfortunately, the complex web of international tax rules and regulations do not make matters any easier. The negative publicity over recent years for the likes of Google and Starbucks has meant that much of the recent focus in international tax has been on the OECD Base Erosion Profit Shifting project, which is designed to make it harder for large multinationals to structure their affairs to unfairly reduce their global tax bill. There is far less focus on the practical difficulties faced by smaller businesses, and therefore the purpose of today's webinar is to provide an overview of common international tax issues which a growing business may encounter. It is often the case that advanced awareness of such issues provides businesses with an opportunity to effectively plan, minimize disruption, and avoid unexpected surprises. The topics we will cover will highlight real-life examples that we have encountered in advising clients in the international arena. It would be remiss not to mention the complication of Brexit and the uncertainty therein. Whilst we certainly cannot provide any guarantees on how Brexit will affect these areas of legislation, we will, however, try and provide some insight and commentary towards the end of the webinar. On that topic, for the avoidance of doubt, I should highlight that indirect taxation is not addressed in this webinar, and nor are payroll taxes. These are substantial topics in their own right, and so companies will also need to consider these aspects. Without further ado, we shall move on to our first topic of withholding taxes. To demonstrate how withholding taxes can cause problems for inexperienced businesses, I recall when a client explained to me that they had undertaken some work for an overseas customer. This was the company's first contract in that country, and everything had gone smoothly. The services were provided on time and to the customer's satisfaction. However, when payment for this work was received, my client was shocked to find that 20% of the total due had been withheld from the payment, negatively impacting their cash flow. The tax legislation in the relevant country dictated that 20% of the contract value had to be paid to the tax authorities of the country. Furthermore, the client could not reclaim this tax suffered and was not able to claim a tax deduction in the UK for the expense. As you would expect, the next time that my client negotiates the contract in that country, they had learned their lesson. The company took advice to fully understand the withholding tax position of that country. As a result, the withholding tax position was discussed with the customer as part of the negotiations, and the company were able to negotiate a higher contract price to protect their profit margin and anticipate the additional cost. Whether or not withholding taxes are applicable is determined by the tax legislation in the relevant country. Therefore, the first step of any effective planning is determine under what circumstances withholding tax is required to be deducted from foreign payments. Often this is dictated by the nature of the payment, with different types of payment having differing tax treatments in differing countries. Broadly speaking, it can be common for withholding taxes to be applicable to the likes of royalty payments, interest payments, and payments for the provision of technical services. It could be, for example, that in a particular country, payments for software licenses are treated as a royalty and tax withheld. With this knowledge, a simple piece of planning may be to consider the invoicing process. If withholding taxes will only apply to an element of the service or contract value, it may be possible to unbundle the invoice by being more accurate with the invoice descriptions and values. Perhaps billing the taxable element of the project separately, which will hopefully reduce the income subjected to withholding tax. Once it has been established that withholding taxes are applicable, the next step of effective planning is to assess whether the UK has a double tax treaty with the relevant country. The UK has an extensive network of tax treaties, and many of these will either negate withholding taxes or allow for reduced withholding tax rates to apply between residents of the two territories. There's a word of warning here. Where a double tax treaty provides an opportunity to apply reduced withholding tax rates, it is often the case that there is an administrative process to be undertaken in advance of being able to benefit from the reduced rate. These processes can take different forms, for example, obtaining a tax residence certificate or simply completing and filing a specifically designed form, but it is often time-consuming. I have seen instances where it has taken over 3 months to get the necessary clearance to apply reduced withholding taxes from the tax authorities. As you would expect, practically this can cause problems and potential delays in terms of contract delivery or settlement. Therefore, an awareness of this pitfall and beginning the planning as early as possible should minimise the disruption to your business. If you find that your business is in the position where it has suffered withholding tax, the next consideration should be whether or not UK tax relief can be obtained for that cost suffered. This is known as double tax relief. In many circumstances, the UK tax relief will effectively reduce the corporation tax liability of the company. This reduction to UK corporation tax will often be the lower of the overseas tax suffered or the anticipated UK tax on the profit of the project which gave rise to the overseas tax. I would like you to note that I specifically said the profit arising from the project, as it is often the case that the overseas tax is applied on the basis of the sales value of the contract. This may mean that it is the case that not all of the overseas tax suffered will be eligible for UK tax relief. There is an example on screen of how double tax relief may be restricted and affect the overall profitability of the contract. In the example, we can see that a £300,000 sale has resulted in a taxable profit of £50,000. However, withholding tax of £30,000 is withheld from that £300,000 sale. As this amount is calculated on turnover, we have an additional overseas tax cost of £20,500 directly as a result of providing the sale in that particular country. In summary, withholding taxes will vary depending on the nature of the transaction, the applicable overseas tax regime, its interaction with the UK tax legislation, and can ultimately affect the profitability of your project. Understanding in advance the applicable withholding taxes and their interaction with the UK tax system allows accurate costing and minimises the chance of unwanted surprises.
Thanks, Mark. So due to the ever global world that we operate in, permanent establishments are probably the #1 recurring issue that we discuss with our international clients. Whilst the fundamental principles can be explained here today, each case does need to be considered on its own merits, depending on the potential overseas jurisdiction involved. So how can a permanent establishment arise, and why does it matter? Well, the reason why it matters is because the presence of a permanent establishment, or not, determines who has taxing rights over those profits that arise in that particular territory. Getting this wrong could lead to interest and penalties being incurred. In terms of how a permanent establishment could arise, What we tend to see is that prior to setting up in a given territory, it's quite common for a UK company to have employees, either UK resident who spend time in the overseas territory, or who are resident of the overseas territory, spending time working there for the UK company. Clearly, this makes sense so as to limit the costs associated with exploring a new market. However, a key concept of international tax is to make a distinction between trading with another country or trading in another country. Clearly, care needs to be taken the moment you have employees working in another territory, especially as the bar for triggering a PE can be low in certain territories, for example in India. As a starting point, it is important to consider the domestic law of the overseas territory to determine whether or not a permanent establishment has been established, and therefore, like I said before, specific advice is typically required. However, as we saw with withholding taxes, the double tax treaties between the UK and the relevant overseas territories may modify or override this domestic legislation. Given that a significant number of the UK double tax treaties are based on the OECD Model Convention, it is possible to consider the definition of a PE under this convention in order to gain a sense of what may or may not constitute a permanent establishment. So the Model Convention defines two ways in which an enterprise may create a permanent establishment in another territory. The first is a fixed place of business PE. This is defined as a fixed place of business through which the business of an enterprise is wholly or partly carried on. There's a significant amount of guidance on what may or may not constitute a fixed place of business, but some of the key factors to point out are that there needs to be an overall kind of degree of permanence. It should be available for use for the enterprise. So in that example, it couldn't include, for say, a coffee shop. And the business of the enterprise needs to be carried on through that fixed place. There are some examples that are provided, which include an office, a factory, or a workshop, which are fairly straightforward to understand. But where it gets tricky is that it also includes a place of management, which has a much broader application, and therefore can catch scenarios where UK companies have employees working from home in those overseas territories. This is something that's open to interpretation. So, for example, would it include working at a customer's site? This may have a degree of permanence. The trade is carried on through that place, but it's unlikely to be freely available to the UK company and therefore probably wouldn't create a PE. But it's something that needs to be monitored and carefully considered. The second way in which a permanent establishment can be created is through what's called an agency PE. This is defined as where a person, other than an agent of independent status, so this rule can't apply if you have an independent third party acting as your agent in the overseas territory, is acting on behalf of an enterprise and has and habitually exercises an authority to conclude contracts. So the key aspects of this are that a person, which potentially includes an overseas subsidiary as well as employees, is operating in another territory, and to the extent they're able to conclude contracts in the name of the UK company, this is likely to give rise to an agency PE. This could be relevant where a sales representative is concluding contracts. Importantly, the wording includes habitually, which demonstrates that there needs to be some degree of reoccurrence over a period of time. Care needs to be taken where the majority of the contract is negotiated in another territory, for it to be just rubber stamped and signed back in the UK. As part of the OECD BEPS initiative, one recommendation was that additional wording should be included in the definition of what makes a PE. This was aimed at situations where the majority of terms were agreed in the overseas territory, and the agreement was then signed without material modification in another. So whilst the UK did not adopt this change, as with most things, it is clearly important to demonstrate that the UK is playing an active part in the contract negotiations and is not just merely rubber stamping these contracts, so as to put beyond doubt that no agency PE is arising. There is an overarching exclusion where the activities in the overseas territory can be considered to be preparatory or auxiliary in nature. This includes the storage of goods or the collection of information as examples. Where activities are deemed to be preparatory or auxiliary, then that will result in those activities not being sufficient to create a permanent establishment. So the key factors to consider here are whether the services need to be, how remote the services are from the actual realisation of profits, whether the activities in the overseas territory compare with those in the UK, and do the activities form an essential part of the business as a whole. Clearly, this can be a useful exclusion in many situations. For example, site visits to collect information or to scope the work, which are undertaken in an overseas territory, but for the work to be undertaken in the UK would not be sufficient to trigger a permanent establishment. In very high-level terms, where a permanent establishment does exist, there's a requirement to consider how much profit should be attributable to that PE. This would be considered to be an amount that it might be expected to make if it were a separate and independent enterprise engaged in similar activities. In effect, transfer pricing rules, which we'll briefly cover later, need to be applied to establish an appropriate amount of profit to attribute to the PE. As the PE is a branch of the UK company, the profits of the PE would potentially be taxed twice, both in the overseas territory and in the UK. As mentioned previously, the UK does allow double tax relief to be claimed. This is calculated by determining the taxable profit of the PE under UK principles, and relief is available for the lower of the overseas tax suffered and the UK tax on those adjusted profits. Alternatively, it is possible to make an election to exempt the PE from UK corporation tax. This branch exemption is irrevocable and applies to all PEs of the UK company. It can be advantageous if the PE is profitable and the rate of overseas tax is lower than the UK corporation tax rate. Note, however, if the branch exemption election is made, losses of the PE are not available for offset in the UK. So we've covered a number of specific points in relation to having a PE in an overseas territory. When expanding overseas, businesses typically have the choice of doing so via a PE. Typically, but not always, this would be a registered branch or through a subsidiary. The subsidiary would be a separate legal entity and will have filing obligations in the overseas territory. There are also a number of commercial, legal and HR factors that would need to be considered, which we're not going to go into detail here today. From a corporate tax perspective, the historic view has always been to use a branch where there are expected to be early year losses, as these losses would be available to the UK company in order to reduce the UK taxable profits, and for this to be incorporated into a subsidiary when the activities turn to profit. One key point to mention is that an overseas subsidiary can be deemed to be a UK tax resident where it's centrally managed and controlled from the UK. So care needs to be taken to ensure that the central management and control of any overseas subsidiary is carried out in that territory and not in the UK. This central management and control would typically include things such as board meetings. Finally, in certain territories, it may be a requirement to have a local shareholder, and this should be checked on a case-by-case basis. One aspect that is helpful with a subsidiary compared to a branch is that the transfer pricing policy can be adopted from the outset and applied in the local statutory accounts. This compares with presenting the branch results in a set of management accounts, where the transfer pricing could potentially be challenged more easily by the local tax authority. So clearly the main driver for operating overseas is to achieve a profit. It's therefore important to consider how this profit can be extracted back to the UK. Profit extraction really starts by considering how you fund the overseas subsidiary. So this could be by way of a loan or through share capital. Typically, if the initial funding can be made by way of a loan, this is probably preferential, as it should be possible to repay the loan prior to extracting profits by way of a dividend. And this is important as there is a risk that in certain local overseas territories, withholding taxes may apply to dividends. So whilst they may be reduced under a relevant double tax treaty, as we've discussed previously, if there's a scenario whereby that can't happen, there might be some tax leakage that occurs. Focusing on the UK, we have a beneficial holding company tax regime that consists of a dividend exemption and a substantial shareholdings exemption. With regards to dividends, in the first instance, all dividends received by a UK company are taxable unless an exemption applies. However, the UK has a very broad set of dividend exemptions that could apply, and in most instances it should be possible to fall into one of the exemptions for normal commercial operations. Care does need to be taken as there are slightly different rules for small companies compared to large. A company is small if in an accounting period it has fewer than 50 employees and an annual turnover or a total balance sheet not exceeding 10 million euros. So dividends received by a small company will be exempt if, at the time the dividend is received, the payer is resident only in a qualifying territory. A qualifying territory for these purposes is defined as a jurisdiction with which the UK has a double tax treaty containing what's called a non-discrimination article. A key point here is that the payer has to be resident only in one territory, and therefore dual resident companies would not fall into this definition. The list of qualifying territories is quite extensive, and it's going to include most of your major territories and most of your European jurisdictions. What it does exclude is certain tax havens, such as Bermuda, but it's important to consider that list. There are certain other conditions that need to be met, such as no deduction being allowed for the payer in respect of the dividend, so care needs to be taken to ensure all of those conditions are met. The number of exemptions for large companies are typically easier to fall into. I won't go into all of the detail of the different exemptions, but the main one that most large businesses fall into is dividends that are received from a controlled company on non-redeemable ordinary shares. So that would be your standard dividend from an overseas subsidiary where you've just got ordinary shares held in that company. Note that there's no requirement for that company to be resident in one territory or for it to be resident in a territory with a suitable double tax treaty. So a dividend from Bermuda to the UK would be exempt. So therefore, whilst it does need to be confirmed on a case-by-case basis, dividends received in most commercial arrangements should usually fall within an exempt class. In respect of substantial shareholdings exemption, at some point in time, a decision will be made to dispose of the overseas subsidiary. Again, the UK has a beneficial participation exemption, which is called the substantial shareholdings exemption. Broadly speaking, this exempts any gain arising on the disposal of trading subsidiaries, provided certain conditions are met. So the main conditions to be satisfied are a 10% holding in a trading company that's been held for a period of 12 months. It's important that the holding is in a trading company, so to the extent that it was an investment company, this wouldn't apply. There are certain other conditions, some of which were relaxed in April 2017, but they're worth mentioning briefly. These changes included removing the need for the company making the disposal to be a trading company immediately after the disposal. Quite often this was problematic where there was a holding company with no trade that disposed of just one trading subsidiary. Prior to the rules changing, this may not have qualified, and therefore it's a welcome amendment. The 10% holding for a 12-month period was previously measured over a 2-year window. This has now been extended to a 6-year period. What this allows for is a significantly longer period of time over which subsequent disposals can still be treated as exempt, even after the investment in the company being disposed of drops below 10%. Finally, the SSE originally included a condition that the company being sold needed to be a trading company after the disposal. This proved difficult because the purchaser had control over this and not the company selling the subsidiary. This condition has now been removed. All of this applies equally where the company being sold is in the UK or overseas. Therefore, hopefully you can see that the SSE and the dividend exemption should allow the extraction of profits in a tax-efficient manner, subject to any local withholding taxes on dividends.
Thank you, Phil. In providing your strategic overview, You've made reference to transfer pricing on a number of occasions, and so we thought it would be worthwhile to provide a brief overview of transfer pricing. Transfer pricing considers transactions occurring between group companies. In general, transfer pricing regulations require group transactions to be priced according to the arm's length principle, i.e. the prices that would have arisen between unconnected parties. Companies within the transfer pricing regime are also obligated to maintain detailed transfer pricing documentation and policy statements. This can represent a significant professional cost to companies who are obliged to keep these records. The UK transfer pricing legislation provides exemptions for small and medium enterprises. If the overseas party is a country which has a tax treaty with the UK with a non-discrimination clause, small companies do not have to comply with the UK transfer pricing legislation, and medium-sized companies only have to apply the rules if specifically directed to do so by HMRC, which would normally be via a formal letter or notice. The applicable definition of small and medium-sized companies for determining whether transfer pricing rules are applicable is based on the EU definition, which is as follows. A small company will have fewer than 50 employees and either turnover or a balance sheet total of less than 10 million euros, whereas a medium company has fewer than 250 employees and either turnover of less than 50 million euros or a balance sheet total of less than 43 million euros. The transfer pricing regime has many obligations and complexities, and it is not something that we can cover in a single webinar. Therefore, it is important to simply have an awareness of when it might apply to your company and when you may require further advice. Whilst this webinar has sought to focus on smaller businesses expanding into overseas markets, as demonstrated by the brief overview of the transfer pricing legislation, there are various complex areas of international tax that may become applicable as the business grows and its practices and operations become larger and more complex. It would be impossible to provide a detailed understanding of all such rules in a single webinar, and therefore, again, the purpose of this section is to provide awareness and a brief overview of some such areas. Firstly, the corporate interest restriction regime is intended to ensure that worldwide groups do not organise their group financing arrangements in such a manner as to obtain a disproportionately high finance cost deduction in tax jurisdictions with comparatively high tax rates. The corporate interest restriction regime replaced the worldwide debt cap calculations with effect from 1st of April 2017. Gladly, there is currently a de minimis limit for application of the corporate interest restriction regime, whereby, broadly speaking, if a group's net UK interest cost is lower than £2 million for a period of 12 months, then this legislation should not apply. Approximately 5 years ago, HMRC introduced the Controlled Foreign Companies legislation. These rules were intended to prevent worldwide groups from organising their affairs in countries with low tax jurisdictions where effective control actually remains in the UK. Broadly, where the majority of voting rights of an overseas company are actually held by one or more UK persons, which includes companies, then the profits of that overseas company are proportionately attributed to the UK companies which hold shares. These allocated profits are then subjected to UK tax at corporation tax rates. There are many exemptions to the CFC regime which can be considered before concluding that a taxable amount arises in the UK company. For example, if the accounting profits of the overseas company are less than £50,000 or £500,000 so long as non-trading income is lower than £50,000, then no taxable profit is assessed on the UK company. Also, many major tax territories around the world are specifically excluded from this legislation. There are some notable exceptions from the EU, which I will mention, which would include Ireland and Switzerland. Country-by-country reporting, or CBCR, is intended to provide greater tax transparency. The ultimate parent company of large multinational enterprises are required to provide an annual return in a standardized format that analyzes and discloses the key elements of their operations. This standardized report is shared with the tax authorities in all of the jurisdictions in which they operate. For your business to qualify as a multinational enterprise and be obligated to make these reports, currently the consolidated worldwide group turnover must exceed 750 million euros.
Thanks, Mark. So that's the conclusion of the bulk of our content for the webinar today. We're going to be available for a few minutes if there are any specific questions, and so feel free to raise those now. I'm conscious of time in terms of running over, so if there are any more detailed questions, we'll come back to those separately. In the meantime, it is worth briefly mentioning Brexit again. It's largely been absent from our webinar today. From a direct tax perspective, it is hoped that there'll be minimal impact. There are certain EU directives that are currently being relied upon in order to reduce withholding tax down to nil in certain cases that may not be the case under the relevant double tax treaty. Hopefully these will be few and far apart, but do need to just be examined in due course. Clearly, the bigger impact of Brexit is going to be around VAT and customs, and businesses need to talk to their advisors to consider that further. So thank you for your time. If you've got any specific queries, then our details are also included on the screen, so feel free to take a note and to get in touch with us. And then just for reference, our next webinar is going to be on the 19th of July. The link is again on the slides, and that's in respect of company house.